Welcome back to the channel. I'm Algabot, and today we're taking a close, educational look at an expert advisor for MetaTrader 5 called Anchored VWAP Probability Bounce. This is a mean reversion strategy built around the anchored volume-weighted average price, a benchmark that many institutional desks watch closely. Over the next few minutes, we'll break down how the strategy defines its bands, how it reads a stretched market, and how it plans its entries, stops, and targets. Everything here is for learning purposes only. So grab a coffee, and let's explore how this approach thinks. So what exactly does this expert advisor do? At its core, Anchored VWAP Probability Bounce is a mean reversion strategy. That means it doesn't chase momentum. Instead, it looks for moments when price has stretched unusually far from a central value, and it studies whether price tends to drift back toward that value. The central value here is the anchored volume-weighted average price, or VWAP. Every time a new calendar day begins, the strategy re-anchors its VWAP to the very first bar of that day. As each new bar closes, it accumulates the typical price and the bar's volume, building a true session-anchored average. Large participants who measure their execution against a daily VWAP benchmark can create a kind of gravitational pull back toward that line, and this strategy aims to study that behavior. Around the VWAP, the strategy builds a statistical band using a volume-weighted standard deviation, which it calls sigma. It then measures how many sigmas away from the VWAP the latest closing price sits. That distance is the z-score. When the z-score becomes large, when price has stretched well beyond the band, the strategy becomes interested in a possible snapback toward the mean. This approach is designed for liquid instruments, foreign exchange majors, major indices, and commodities, and it's typically studied on intraday timeframes from 5 minutes up to 1 hour. The developer notes suggest it tends to behave best in ranging, low-trend conditions, where price oscillates around a mean rather than moving strongly in one direction. As for the type of trader it suits, this is really an educational tool for anyone curious about how anchored VWAP and volume-weighted statistics can be turned into a rules-based, systematic framework. It's fully mechanical. It defines its entries, its stop, and its target with precise math, and it never relies on discretion. Remember, though, every strategy carries risk, and losses are a normal part of trading. Nothing here is a recommendation. Let's walk through the mechanics step by step. The strategy only acts once per newly closed bar, so it's patient. It waits for a bar to finish before making any decision, and it studies the bar that just closed. First, it checks the calendar date of that closed bar. If a new day has begun, it resets its anchor and starts accumulating a fresh VWAP from scratch. Then, for every closed bar of the current day, it adds that bar's typical price, the average of the high, low, and close, weighted by the bar's tick volume. From those, it computes the anchored VWAP and a volume-weighted sigma. Dividing the distance between the close and the VWAP by sigma gives the z-score. Now the entry logic. For a long, the strategy is looking for two things at once. The z-score of the closed bar must be below the negative of the sigma multiple setting, by default, more than 2 sigmas below the VWAP. In plain terms, price has stretched well below the lower band. On top of that, the closed bar must be bullish, meaning it closed higher than it opened. That combination describes a market that has been pushed down hard, but is showing the first sign of snapping back up. When both conditions are met, the strategy signals a buy. The short side is the mirror image. The z-score must be above the positive sigma multiple, stretched more than 2 sigmas above the VWAP, beyond the upper band. And the closed bar must be bearish, closing lower than it opened. That's a market stretched high and beginning to roll back over. When both align, the strategy signals a sell. Now the exit plan, which is defined before any position opens. The take profit is always the anchored VWAP itself, the mean magnet the whole strategy is built around. Because of the entry condition, the VWAP always sits on the favorable side of the entry. The stop loss is based on volatility. It's placed at a multiple of the ATR, or average true range, beyond the entry. By default, that's 1.5 times a 14-period ATR. Before committing, 3 filters must pass. The spread must be below the max spread points limit, so trading costs stay reasonable. The reward-to-risk ratio, the distance to the VWAP divided by the stop distance. must meet the minimum, which defaults to 0.8. And at least 2 bars must have formed since the anchor, so sigma is meaningful. Only one position runs per magic number at a time, and the stop and target handle every exit. Here's the heart of the MQL5 code as you'd see it in Meta Editor. At the top are the input parameters you can adjust in the strategy tester. Sigma multiple sets how many volume-weighted sigmas define the band, the z-score threshold, defaulting to 2. ATR period and ATR stop multiple govern the stop distance, using a 14-period ATR times 1.5 by default. MinRewardRisk sets the minimum acceptable reward to risk, max spread points filters out costly spreads, and lots and magic control order size and identification. Just below, the code computes the z-score of the closed bar as its close minus the VWAP, divided by sigma, and it flags whether the bar was bullish or bearish. Now look at the long block. The condition reads, if the z-score is below minus sigma multiple and the bar is bullish. Inside, the entry is the ask price, the take profit is set to the VWAP, and the stop is the entry minus the stop distance. It calculates reward and risk, and only if both are positive and the reward to risk meets the minimum does it call trade.buy, passing the lots, the stop, and the VWAP target. The short block is the exact mirror. If the z-score is above sigma multiple and the bar is bearish, the entry is the bid, the take profit is again the VWAP, and the stop is the entry plus the stop distance. After the same reward to risk check, it calls trade.sell with the stop and the VWAP target. Both sides share the identical structure, stretched beyond the band, a confirming candle, then a defined stop and a VWAP target. That symmetry is what keeps the logic clean and easy to reason about. Let's bring this to life on the chart. Across the price action, you can see 3 lines. The anchored VWAP in the middle, with an upper band and a lower band drawn at the sigma distance on either side. These bands are what the strategy watches for a stretch away from the mean. Watch the opening candles on the left. Price starts near the anchored VWAP and begins drifting lower, candle after candle. The selling continues, and by the third and fourth candles, price has pushed down and moved below the lower band. At this point, the closing price sits well beyond 2 sigmas below the VWAP, so the z-score is deeply negative. But notice the strategy doesn't act yet, because these candles are bearish. A stretched market that's still falling is not a signal on its own. The strategy wants evidence that the snapback is beginning. That evidence arrives on the next candle. It opens near the lows but closes higher than it opened, the first bullish candle after the stretch, still sitting below the lower band. Now both conditions are satisfied. The z-score is beyond the negative threshold, and the bar has turned bullish. On the following bar, you can see the buy entry marker appear. The stop loss is placed a set distance below, at 1.5 times the ATR beyond the entry, sitting just under the fresh low. And crucially, the take profit is set right at the anchored VWAP, the mean the strategy expects price to drift back toward. Before entering, it also confirmed the distance up to the VWAP was worth at least 0.8 times the risk down to the stop. Now follow the recovery. Candle by candle, price lifts off the lower band and climbs back toward the middle. The buyers who stepped in at the stretch carry price up, and a few candles later it reaches the anchored VWAP line, where the take profit marker sits. The long idea has played out exactly as designed. A stretch below the band, a bullish confirmation, and a drift back to the mean. But price doesn't stop at the VWAP. Momentum carries it higher, and now watch the other side of the setup develop. Over the next candles, price pushes up through the upper band. The closing price is now stretched more than 2 sigmas above the VWAP, a positive z-score beyond the threshold. Again, the strategy waits. The candle that first moves above the band is bullish, so there's no signal yet. A stretched, still rising market isn't enough. Then the rollover appears. The next candle closes lower than it opened, the first bearish candle, while price is still stretched above the upper band. Both short conditions now line up. The z-score is beyond the positive threshold, and the bar has turned bearish. On the following bar, the sell entry marker appears. This time the stop loss sits above the recent high, again at 1.5 times the ATR beyond the entry, while the take profit is set back down at the anchored VWAP. From there, price rolls over and works its way lower, candle by candle, back toward the middle of the range. It slides off the upper band and returns to the anchored VWAP line, where the short take-profit marker sits, completing the mean reversion move. So in this single illustration, you've seen both halves of the strategy. A long from a stretch below the lower band that snaps back up to the VWAP, and a short from a stretch above the upper band that rolls back down to the VWAP. In both cases, the anchored VWAP is the magnet. The sigma bands define the stretch, and a confirming candle provides the timing. This is a simplified, idealized example, of course. Real markets are noisier, and not every stretch returns to the mean. That brings us to the end of our look at Anchored VWAP Probability Bounce. We covered how it re-anchors its VWAP each day, how it builds sigma bands and a z-score to measure stretch, how it waits for a confirming candle before signaling a long or a short, and how it defines its ATR stop and its VWAP target. I hope this gave you a clearer picture of how anchored VWAP and volume-weighted statistics can be turned into a systematic framework. Remember, this video is educational content only and not financial advice, a recommendation, or a solicitation to trade. If you found it helpful, please like the video, subscribe for more MT5 strategy breakdowns, and leave a comment with the strategy you'd like us to analyze next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.